The markets have officially opened for the new calendar year, and the AI trade has helped markets see 3 consecutive years of not just gains, but double-digit gains. There's Jensen Huang there on your screen. There's heavy concentration, of course, in Megatech, the S&P 500's top 5 companies, at least by market cap, making up 30% of the index's total value. So, if you're looking to diversify, where do you look? Well, the crypto industry is still a bit bullish after a shocking downturn in 2025. How about dividend plays, just so you can earn some guaranteed return on your investment? Joining me now to share his thoughts as we kick off a new year, Kevin Kelly, CEO of Kelly Intelligence. Kevin, Happy New Year to you. Thanks for being here for the broadcast. So the S&P 500 currently trading over 25 times current PE. Why is 2026 set to be a year to diversify away, you say, from these high valuation names?
Well, one of the reasons why that high valuation names could be a concern to investors this year is that there needs to be of execution, right? All these companies need to execute on every single facet of their business and really deliver. And so when you look at the broad market, if you look at the top 1,000 names that trade in the United States here, there are a lot of names that trade at a discount to that 25 multiple on the broad-based averages. You can get into names that trade at 15 times earnings, 16, 17, those still can be relatively high in certain market environments, not in this one, obviously, with interest rates having come down. But there are a lot of opportunities out there to get the same exposure that you would in some of those big mega names. And you're still getting access to those sectors and themes, but you can pay a lower multiple for them.
All right, talk to me a bit more about not just diversifying here, but dividend investing. Why, first of all, are you looking at dividend stocks in this particular environment? And how can investors be maybe a bit careful, a bit cautious when going about which dividend names to go after?
Yeah, I think this is the most important thing, is that dividends have historically been a great place to invest. Since 1929, it's accounted for over 40% of the total returns of the entire market. And you're actually even seeing a lot of mega cap names implement dividends. And dividends have been a great place to get risk mitigation. And so when we talk about high multiples and valuations, a lot of dividend names, especially growing dividend names, you can get into. What a name, for example, like Qualcomm, right? So if you look at Qualcomm, they trade at a lower multiple, almost half of what Nvidia trades, and Qualcomm has been expanding into the AI space. So we think there's a lot of different ways to do that. That's a technology AI play. You can even look at the consumer staples space. Look at Walmart. Walmart's trading for perfection, right? They're almost around a 40 PE. When you can get a similar name like Dollar General that pays a dividend, has a higher dividend, and you can get access to the same space that way.
Yeah, Qualcomm's dividend, 89 cents. Walmart at 23, to your point. How will dividend stocks, you think, fare here in the new year, 2026, when we think about market factors, things like presumably a more dovish Fed lowering the short end of the yield curve and interest rates, the general AI trend? How does all that factor in?
Yeah, so that's a great point, because we've actually seen historically over the last several years, we've had great markets. I mean, if you're getting 20% returns, 3, 4, 5 years in a row on average, then you're really happy. But that's not sustainable going forward. And we've actually seen this market is one, very overpriced in terms to history. So at 25 multiples and at the dividend yields that the broad-based market is paying, it's expensive. And so one of the ways that you can actually kind of protect yourself is those dividends, high free cash flow names that can go out there and take advantage of the market should there be a pullback. So we know we've seen volatility, right? Like last year with the tariffs, we've seen big pullbacks. So you can be in spaces like dividends, like high free cash flow companies, and take advantage of volatility when it does arise. And we are seeing the macroeconomic environment is actually, it's bifurcated, right? We're getting strong data, we're getting soft data. So it's really hard to predict. So that's why you can take refuge in high dividend names.
Kevin, what do you think are the big drivers for the new year's for diversifying digital assets? For anyone out there still a bit surprised at the performance of a lot of those crypto majors in the last quarter of 2025?
Yeah. So dividends and digital assets are great places to diversify and really protect your portfolio on an efficient frontier. And one of the reasons why we say that is because if you look at the investment happening in the digital asset space, it's voracious. You're seeing the regulatory environment do very well for it. So if you take a company like Western Union, right? They don't want to be Kodak. So what did they do? They're actually implementing a stable coin using the Solana network to actually not lose out on business because everyone's using stablecoins now and everyone's using for global remittances other different types of platforms like XRP. And so when you take a step back and look at, okay, if I was going to send money globally, it's costly, it's time consuming. Digital assets reduce that. So that's why Western Union's using Solana. You're looking at even Zelle, the payment platform. They're looking to, and that's all the big major banks, they're looking to use stable coins for global remittances as well. And so when you're seeing a voracious amount of investment going into these digital assets by companies to reduce cost, to increase efficiency, I think it's a great way to diversify your portfolio. And you can do that in the alts bucket. You could do that in the tech bucket. One of the things I always look at is these are technology networks. And so if you have significant exposure to the Mag 7, the Mag 7 has similar volatility to digital asset networks, these technology networks. And so you can diversify that and make it into the beautiful 8 because you're still having the same kind of technological growth and volatility within your portfolios.
Kevin Kelly, CEO of Kelly Intelligence, thanks a lot for being here for this, our first show of 2026. Happy New Year to you, Kevin.
Happy New Year. My pleasure.